If you've walked into a bank lately, someone behind the counter has probably tried to sell you on a CD, urging you to lock in the rate. Guaranteed return, zero risk, 4%, they say. After the Fed's rate cuts over the past year, that pitch feels more urgent than ever before. Here's what they don't walk you through: what locking in a CD actually costs you over 10 years, compared to a total market index fund. Today we're running the real math, using where rates actually stand right now, and the gap will surprise people who think CDs are safe. Let's ground this in reality first, because context genuinely matters before we get into any of the actual numbers ourselves. Over 2025, the Federal Reserve cut rates 3 separate times, bringing the benchmark down to around 3.5 to 3.75%. Those cuts pulled CD yields down too. The best CDs, once paying 5% or more, now mostly hover closer to 4%. Meanwhile, inflation has been running around 2.5 to 3% yearly, meaning a 4% CD's real return is barely 1%. Most forecasters expect the Fed to keep cutting gradually, meaning every time your CD matures, you're likely renewing into a lower rate than before. That's the trap nobody mentions when they're pitching you the urgency of locking in this rate before it supposedly disappears forever. Quick refresher, since many people use these without fully understanding the mechanics behind how a certificate of deposit actually works. A CD is basically a fixed-term loan you give a bank 6 months, a year, 5 years, for a fixed interest rate return. It's FDIC insured up to $250,000 per depositor, making it about as close to risk-free as investing genuinely gets. The catch is the trade-off: your money is locked up, and pulling it out early typically costs you an early withdrawal penalty. So a CD gives you certainty and safety from principal loss, but no growth that meaningfully outpaces inflation, and no real flexibility either. Let's run this over a full decade, because a single year's comparison completely hides the real, long-term story here. Say you have $50,000 in a rolling CD ladder, renewing every time one matures, for 10 straight years in a row. Given where rates likely head as the Fed keeps easing, a realistic average yield across the decade might land around 3 to 3.5%. At that rate, $50,000 would grow to roughly $68,000 to $69,000 after 10 years solid, safe, predictable growth. Now take that same $50,000 and invest it in a diversified index fund instead, left untouched for the same 10 years entirely. Using a conservative 7 to 8% average return, that $50,000 could grow to somewhere between $98,000 and $108,000. That's a gap of roughly $30,000 to $40,000, same starting amount, same 10 years, and that's before adjusting for inflation. Here's the part of the CD pitch that almost never gets mentioned honestly: reinvestment risk, quietly working against you over time. When you buy a CD today at 4%, that rate only applies for that specific term. Nothing is guaranteed once it matures. In a rate-cutting environment like the one we're likely heading into, your next CD could easily pay 3% or even lower. Locking in 4% for 1 year doesn't protect you from lower rates in year 2, 3, or 4, it just delays impact. An index fund doesn't have this problem. There's no maturity date forcing you to accept whatever the market offers that particular week. Your money simply stays invested, riding out natural ups and downs over the decade, instead of getting repriced downward with each renewal. This brings us to the actual myth worth naming, that CDs are safe and index funds are risky, full stop, end of discussion. That framing misses half the picture. CDs protect your principal, but carry a quiet risk of failing to outpace inflation over time. Index funds carry real short-term volatility, but historically, over full decades, that volatility has been rewarded with growth outpacing both inflation and CDs. The real question isn't which one has zero risk, since neither does, it's which risk you're choosing, and what you're trading away. Now, to be fair, CDs absolutely have a legitimate place, and this isn't an argument for abandoning them entirely across the board. If you have a specific expense coming in 1 to 3 years, a CD makes genuine sense. Certainty matters more than growth there. CDs can also serve as a piece of your emergency fund strategy, particularly while current rates remain meaningfully above inflation for now. Building a CD ladder, staggering maturity dates, can give some liquidity while still capturing today's decent yields before further cuts arrive. But for genuinely long-term money, parking large amounts in CDs means accepting a much lower growth ceiling, especially as rates trend downward. So here's a simple framework: money needed within 1 to 3 years belongs in CDs or high-yield savings, not the stock market. Money you won't touch for 5, 10, 20 years has historically grown far more in index funds than in CDs, once inflation's factored in. For emergency funds, a blend often works well, some in high-yield savings for instant access, some in short-term CDs for slightly better rates. The goal isn't picking zero risk, since that doesn't exist, it's matching the right tool to the right timeline for your money. Now someone will say, but what if the market crashes right after I invest, instead of the CD holding steady the whole time? That's fair, and it's exactly why this comparison is about long-term money. Markets have recovered from every downturn and reached new highs. CDs don't crash, but in a falling rate environment, they guarantee a quietly shrinking yield with every renewal, with no upside to offset it. So here's the honest math: after 2025 and 2026's rate cuts, CDs still make sense for short-term money and part of your emergency fund. But for long-term wealth building, locking large sums into CDs means accepting a lower ceiling as rates keep trending downward with each renewal. That $30,000 to $40,000 gap isn't a fluke, it's what happens when safety gets prioritized over growth unnecessarily, decade after decade. If you currently hold significant savings in CDs beyond short-term needs, I'm not saying pull it all out today, that's a personal decision. But now you've seen the real numbers behind that decision, using rates as they actually stand today, not some outdated headline number. Tell me in the comments, are you locking in CDs right now, or writing it out in the market instead, and why? If this helped you think more clearly about where your money should sit, hit subscribe for next week's honest breakdown too. I'll see you in the next one. Thanks so much for watching, and make your money work as hard as you do.